Hey everyone, thank you all for tuning in. Just wanted to really just give some value at this tax crazy time. So we got John Remillard here. He is my go-to CPA. He is amazing at what he does for first-time home buyers as well as small business owners. Just really here to answer some questions that you might have about preparing for maybe your first year of filing taxes as being a homeowner or a potential homeowner. So let's get started. Well, John, you want to talk a little bit about, who you are, or was that a good intro?
That was a good one. I'll add a little more. Thanks for inviting me, Danielle, to talk today. Like Danielle said, my name is John Remillard. I'm a CPA at Boisselle, Morton, and Wolkowicz, LLP, in Hadley, Massachusetts, where I focus on individual and small business taxes. I've been a CPA for 4 years now, an accountant for 8. So I've had experience working with many people across the income spectrum, and also in terms of their tax situation, whether it be buying a home, like in this case, owning a small business, renting properties, anything you can imagine. So that's really it, I think, for now, for the purpose of this conversation. Won't get too deep.
Yeah, and it's going to be short and sweet. So really, the first question, any additional ways to come up with funds for a down payment aside from cash? Any tax consequences to these?
Yeah, so this is a question we hear a lot. Depending on how much money people have in the bank, there's a few different ways you can obtain additional funds to put down for the purchase of your first home, which could potentially save you some PMI or get you into a better down payment area with someone like Danielle, who's your lender. There's 2 main ways. You can do through a retirement plan is the best way, 401k with your employer. There's 2 options there. If your plan allows it, you can take out a loan against your balance. There's different rules depending on the plan you have, so it's best to contact your plan administrator. But as long as you plan to repay the money back, you can take a loan out and not have any taxes there. The second option is if you're considered a first-time home buyer in the eyes of the IRS. This is if you haven't owned a home in the last 2 years. So you could have owned a home prior, but if you weren't living in a home, maybe you were renting for 3 years, you'd still be considered a first-time home buyer. With that, if you do qualify as a first-time home buyer, you can withdraw up to $10,000 per individual's retirement account. So if you're married, you can take $10,000 from the taxpayer and your spouse. With that, you still have to pay ordinary income tax on that $10,000 amount. But if you're under the age of 59 and a half, you don't have to pay the 10% early withdrawal penalty on any money you take out, which is huge. You could be looking at, depending on your tax rate, you could be looking at almost $800, $1,600, $2,000 of an early withdrawal penalty. So not having to pay that would be great. You just need to let your tax preparer or yourself make sure you enter the right code on the distribution to make sure that you don't get that 10% early withdrawal penalty.
Yeah, that's good to know. Holy cow, because I know in my world, a lot of people are borrowing money against their retirement, which, like you said, is definitely a good thing to do. So what expenses are potentially a tax deductible for the home buyers in regards to the home?
Yeah, there's a few expenses that are tax deductible. A lot of people think that just when they buy a new home that it's going to be written off on their taxes, but unfortunately, with the new tax laws in 2018, that might not be the case, but I'll get into that a little now. Potential expenses that you can deduct: mortgage interest, mortgage points, private mortgage insurance, the favorite PMI, and also real estate taxes. All of those are only deductions if you itemize deductions on your tax return. When I say itemized deductions, most of you have probably taken the standard deduction in the past couple of years, which is now going to be $12,550 for an individual taxpayer, or $25,500 for a married filing joint couple. With that big increase in the standard deduction, a lot of people haven't been itemizing their deductions. So like I said, those expenses still might not get you into that range. The big thing being, so you can take the full amount of mortgage interest, the points, and the PMI as a deduction, potentially. But with real estate taxes, those are capped under what's called SALT tax, state and local tax deduction. You're only allowed to deduct $10,000 of those taxes on your tax return. State and local taxes include real estate taxes, personal property, excise taxes on your vehicles, and also state taxes paid in your home state, any other states you work in. That's a $10,000 cap. So if that plus all the other expenses I mentioned, as well as charitable donations or medical costs, doesn't exceed that standard deduction amount I said earlier, you might not be able to deduct those costs, but it's really on a case-by-case basis. You just have to evaluate it. The best time where you might be able to itemize deductions is in the first year that you buy the home. You might have paid some points to get the mortgage. You might have more PMI if you had a full year of the loan. So that's an option. Also, if for some reason you refinance down the line and you had to pay closing costs, any other points with that, that's really a good time to itemize deductions. If you're a single taxpayer, you'll likely exceed the standard deduction with all those in play, but married couples really have a tough time with that state and local tax deduction cap of $10,000 to itemize deductions. But yeah, if you have any questions, always best to ask your tax preparer if you qualify, or you can, if you file your own taxes, you can always check through TurboTax. There's a free software like that to see if you qualify.
Awesome. Thanks so much. That is so important. And I feel like I have that question, and I feel like I always want to reach out to my past closed business just so they know what to do and what to expect. So thanks for that. Are there any other considerations for any first-time home buyers, any little pieces of knowledge? I know you just went through not a first-time home buyer, but just purchase. So you got any insight for them?
Yeah, there's a couple of things to keep an eye on, especially depending on your income situation. If you're self-employed, there are more deductions you can take as a first-time home buyer. You might be able to take a home office deduction, where you can take a portion of your expenses paid in the calendar year for the home. That includes utilities, mortgage interest, real estate taxes, any repairs you make, home insurance. Those are potential deductions you can take as long as you have a separate home office dedicated to your business. So it can't just be your kitchen table, your couch, no matter how comfortable that couch is. It should be your own room in the house. The only thing I would say is just be careful with this deduction. The IRS is normally looking between 10 to 20%. I've had people who, of the house being a home office, I've had people who try and tell me, oh, 80% of my house is home office, or use my whole house. Like that's going to raise a red flag with the IRS. You need to live in some part of your house, whether you use it or not for storage or whatnot for your business. So just be careful. A lot of times when you buy a house, getting in touch with a CPA such as myself makes a lot of sense, just to make sure you have that deduction sorted out and that you're not taking too much of deduction or raising too big of a red flag if you are self-employed. Another thing to be careful of is if you plan to sell your house within 2 years of purchase, which I actually did on my prior house. If you do sell within 2 years, you do have to pay capital gains tax on the sale. So if you any gain that you have after factoring in closing costs on the sale, the original purchase price, any improvements you made, you could potentially be liable for capital gains tax, which is anywhere between 0 and 20% based on your income. You can't avoid this tax if you live in the house for more than 2 years out of the past 5 years. It's called the home sale gain exclusion. So any gain, if you're a single taxpayer, that's up to $250,000, or a married couple, that's the gain is up to $500,000. You can fully exclude that gain as long as you live in the house for over 2 years. So that's a key point. If you can reach that 2-year mark, it's great. You don't have to worry about even reporting the sale on a Schedule D for capital gains. You you can just report it on a separate worksheet and there's no tax consequence if you live for over 2 years. So that's really a big thing if you can try and get to that point, or even if you do move out of the house, just hitting that 2-year mark over a 5-year period. So it can be 1 year in the beginning, 1 year at the end of the 5-year period. As long as you do that, that's big. So
yeah, I was unaware of that. That's very interesting, and definitely some good information, especially with the way the housing market has been, where people have bought and they've turned around and sold because, I mean, it wasn't their forever home, and they went out and bought something new. So yeah, that's really really important to know. Thanks.
yeah,
And just a little pivot on the self-employed income, they've just recently, Fannie Freddie has just recently lifted some of the requirements, like having profit and loss up to date. So that's been good. So the self-employed borrowers aren't going to be as scrutinized as they were during the pandemic when it was heightened. So that's a good thing. Anything else you got to know? I know we want to keep it kind of rather quick, just quick and short and to the point. So.
yeah, not too much else. I mean, if there's any other considerations that you're thinking with your home, if you plan to rent out a space potentially to someone on a full-time basis, or if you plan to rent the home out, say for an Airbnb, if you're away, you want to make some extra money. There are some tax consequences there to deal with as well, in terms of depreciating the home, setting aside the correct expenses. So things of those natures is a good time to get in touch with a CPA just to talk it through and make sure you're not missing any deductions that you could take, or make sure you're reporting everything correctly. But if you're worried about any of these areas or on how to claim any deductions, Danielle will provide my contact information at the end of this meeting. You can reach out to me with a quick call. I'd be happy to help anybody here with an introductory call. Or if you think you need my services, I'd be happy to talk that through as well.
Okay. Awesome, John. Thank you for taking a quick minutes out of your crazy day. I know you're ramping up CPA World Tax Time, so I greatly appreciate you sharing some great feedback to my clients and to my sphere of influence. So thank you so much, John.
You're welcome, Danielle.
Thanks.
Bye-bye.
Bye.